We're diving into the fascinating world of stablecoins today. You know, those digital currencies trying to keep their value steady, sort of a bridge between regular money and the crypto Wild West.
Exactly. And they're popping up more and more international payments, maybe even some stuff SpaceX is doing, reportedly.
The idea makes sense of a digital dollar, essentially, but there are hundreds out there. How do you figure out which ones are actually solid?
That's the million-dollar question, isn't it? Most folks glance at market cap, how big it is.
Right, which tells you about popularity, maybe how easy it is to use, but that doesn't really tell you about, like, the quality, does it?
Not the whole picture, no. So our mission today is to dig into a really rigorous, data-driven method for rating stablecoins. We're leaning on some academic research that actually developed and tested a system for this.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Okay, interesting. So moving beyond just market cap, what key things does this research actually measure to gauge quality?
They focus on 5 core characteristics. First, average deviation, basically. How far off that $1 target does it usually drift?
Okay, like price accuracy.
Precisely. Then there's volatility. How much does the price jump around over time? Price stability.
Got it. What else?
Third is persistence. If the price does wobble away from $1, does it tend to stay wobbly or snap back quickly?
Like how sticky the problems are.
You got it. Fourth is liquidity. How easily can you actually trade it for other things without messing up the price?
Makes sense. Got to be usable. And the fifth?
And fifth, well, they do include market cap, recognizing it is a factor for general usability and network effects.
Okay, 5 different things. Deviation, volatility, persistence, liquidity, market cap. But how do you, compare a small price deviation number to a huge market cap number? They're totally different scales.
Great question. That's where their scoring system gets clever. For average deviation and volatility, they use a logarithmic transformation specifically, the negative log base 10.
Whoa, okay. Why the logarithm?
Well, think about it. Tiny deviations matter a lot for stability. A coin that's off by 1/10 of a cent is very different from one off by a full cent. The log scale really emphasizes those differences in decimal places, those percentage changes. It stops huge raw differences from totally overshadowing everything else.
Right, it kind of zooms in on the small, important fluctuations. Okay, so that handles the price stuff. What about the others? Persistence, market cap, liquidity.
Persistence is already a fraction between 0 and 1, measuring that stickiness. So they just transform it simply by calculating 1 minus persistence. Lower persistence is better, so this flips it to a higher score being better.
Simple enough.
For market cap and liquidity, they also use a log transformation. For liquidity, though, they add 100 before taking the log.
Add 100, why?
It's a neat trick. It avoids issues with very low liquidity numbers, especially for new coins, potentially giving negative scores after the log. And interestingly, using the log for liquidity also makes the score more robust against wash trading those fake self-trades. Because to significantly boost a logged liquidity score requires exponentially more actual volume as the real volume grows. It becomes really expensive to fake it convincingly once a coin has any real traction.
Clever. Okay, so logs help normalize things and add some robustness. But you still have 5 scores measuring different concepts. How do you put them on the same page?
That's the next step, max normalization. For each transformed measure deviation, volatility, persistence, liquidity, market cap, they find the best score achieved by any stablecoin in their entire study period.
The absolute peak performance for that metric.
Exactly. Then, for every stablecoin, they divide its score on that metric by that maximum value. Everything ends up on a scale from 0 to 1.
So the best performer on, say, volatility gets a 1, and everyone else gets a score relative to that best performer.
Precisely. It grades them on a curve, essentially, for each characteristic.
Was there a deep reason they picked this specific normalization method? Sounds like there might be others.
There are, but they actually provide a strong theoretical justification for max normalization. They show it's uniquely suited because it satisfies certain desirable properties. They call it an axiomatic characterization, meaning it preserves relative ratios properly. Adding a poorly performing coin doesn't subtly change the relative scores of the good ones, and the best always scores 1. It's not just arbitrary scaling. It has solid mathematical underpinnings for fair comparison.
Okay, that adds a lot of weight to the method. It's not just plucked out of thin air. So now you have 5 comparable scores, 0 to 1, for each stablecoin. How do you combine them into one overall rating?
They use a geometric mean. Instead of adding the scores and dividing, you multiply all 5 normalized scores together and then take the 5th root.
Geometric mean? Why that instead of a simple average?
The key advantage is that a really bad score in one area will pull the overall rating down significantly. You can't just ace, say, market cap and have terrible volatility and still get a high overall score.
Ah, so it penalizes inconsistency. Makes sense for something called a stablecoin.
Exactly. You need to be reasonably good across the board. A single great score can't paper over cracks elsewhere.
Right. So let's get to the results. They applied this method to real stablecoins over a period, right? From 2022 to late 2024. What did they find? Who came out on top?
Yeah, the findings were quite revealing. Looking at the average ratings over the whole period, it wasn't a single winner throughout. Initially, in the first half they studied, USDT actually edged out the others slightly in the mean and median rating. But then in the second half of the data, USDC pulled ahead and consistently ranked higher. BUSD and DAI were often in that next tier down.
So a definite shift happened. Any idea what drove that? Were there specific events?
Absolutely. The data reflects real-world events quite well. Take BUSD, the Binance stablecoin. It started off strong, sometimes even topping the ratings.
Yeah, I remember it being pretty big.
But then Binance announced they were phasing out support for it around September 2023. And boom, the rating just falls off a cliff in the researchers' charts. You can see a clear downward trend. According to their data, it hasn't been the top-ranked coin even for a single day since February 2024.
Wow, so that really highlights a major vulnerability, doesn't it? Your stability depends heavily on the platform supporting you.
Precisely. It's a key downside risk reliance on specific corporate infrastructure or regulatory decisions.
What about the algorithmic stablecoins, the ones using code, not cash reserves, to hold the peg? How did they fare in this rating system?
Generally not as well. Coins like FRAX, MIM, OUSD, FEI consistently showed lower ratings throughout the study period.
Any reason why?
It mainly comes down to higher volatility, which drags down their scores. This lines up with what other researchers have found too. Those algorithmic mechanisms, while innovative, seem inherently more prone to price swings.
So the complexity designed to keep them stable can actually introduce instability, another potential downside.
Seems that way based on this analysis.
Were there other major shocks reflected in the ratings?
Yes, definitely. The Silicon Valley Bank crisis back in March 2023 caused a noticeable, though temporary, dip in USDC's rating.
Because Circle held reserves there, right?
Exactly. You saw a short spike in its deviation, volatility, and persistence. But confidence was restored relatively quickly after the government stepped in to guarantee deposits, and USDC's rating bounced back.
So even a well-backed coin isn't immune to shocks in the wider financial system, another risk factor.
For sure. It shows the interconnectedness.
Okay, so this rating system seems to capture these real-world dynamics pretty well. What's the single biggest takeaway you get from looking at these results versus just, say, market cap?
I think the most crucial insight is that market cap is not a reliable proxy for overall quality, as measured by this more comprehensive method.
Right. Bigger isn't always better.
Definitely not. While USDT and USDC are the giants by market cap, their quality ratings relative to each other shifted, and BUSD was sometimes top-rated before its issues. The researchers even have charts showing clear examples where lower market cap coins had higher quality ratings at specific times.
So you really can't just look at the coin market cap rankings and assume that tells you the quality story.
Not at all. You need to look at these other factors, the actual price stability, the persistence of deviations, the liquidity. They also showed a chart, figure 10, illustrating USDC increasingly outperforming USDT in the quality ratings over time, even while both had massive market caps. And they tallied the number of days each coin held the #1 rank again, painting a much richer picture than just size.
That really drives the point home. Now, this rating method sounds robust, but are there any potential downsides or limitations to the approach itself we should keep in mind?
Sure, definitely. No method is perfect. We already touched on some risks the ratings reflect. Platform dependency like BUSD, inherent volatility for algorithmic types, and systemic shocks like SVB affecting USDC.
Right. Those are risks of the stablecoins. What about risks or limitations of the rating method?
Good point. Methodologically, the researchers chose a 30-day rolling window for their calculations. They did test a 90-day window and said it didn't change things much, but that time horizon could matter in some circumstances.
Okay, the calculation window matters.
Also, the specific group of stablecoins they included in the analysis, the set S, influences the max normalization step because the maximum score comes from within that group. They argue it's fairly stable if you include the major coins, but it's still a factor.
So who you compare against sets the curve.
Exactly. And finally, while they strongly justify max normalization, they do acknowledge other normalization techniques exist. It's still an area of research and discussion. So it's a powerful tool, but it has specific design choices.
Understood. So it's a valuable lens, but maybe not the only possible lens, and has its own assumptions built in.
Well put. It's a major improvement over just market cap, offering a much more nuanced view based on quantifiable metrics.
This has been incredibly helpful. It feels like we have a much better handle on how you might actually measure stablecoin quality beyond just the headlines. The big takeaway for me is definitely that size isn't the whole story.
Absolutely. This kind of multi-factor rating looking at stability, liquidity, persistence gives you far more granular understanding.
And based on this specific method and data period, it seems USDC emerged as a strong performer, but the BUSD example is a stark reminder that things can change fast.
Indeed. The landscape is dynamic. Vigilance and looking at these underlying metrics are key.
So here's something to chew on as we wrap up. Given how fast this space evolves and thinking about the strengths and maybe limitations of this kind of data-driven rating, what else might become crucial? What new metrics or maybe qualitative factors will we need to consider down the road to truly gauge the long-term reliability and stability of these digital dollars? Definitely food for thought.